For decades, Japan stood as a colossus in the world of international finance. The nation, once devastated by conflict, had transformed itself into an economic powerhouse. Its banks and financial institutions extended their reach across the globe, funding projects, supporting economies, and wielding considerable influence. This financial dominance underscored Japan's role as a key pillar of the global economic order. The world looked to Tokyo not just for technological innovation, but also for capital. The significance of being the world's largest lender cannot be overstated. This financial leverage allowed Tokyo to shape international development and investment trends. However, the tides of international finance are ever shifting. Today, on May 28, 2025, Japan no longer wears the crown as the world's largest creditor nation. This transition marks a significant moment, reflecting profound changes both within Japan and in the broader global economic landscape. The story of this shift is complex, involving decades of internal economic struggles and the meteoric rise of new financial powers. Understanding this change is crucial to grasping the current dynamics of the global economy. The implications of this change are far-reaching. For Japan, it necessitates a re-evaluation of its economic strategies and its role on the world stage. This essay will delve into the historical arc of Japan's financial dominance, explore the multifaceted reasons for its decline from the top lending spot, and analyze the rise of new economic giants. Japan's journey to becoming a financial superpower began in the ashes of World War II. The nation faced utter devastation, its industries crippled and its economy in ruins. Yet from this desolation emerged one of history's most astonishing economic recoveries. This Japanese economic miracle was fueled by a combination of factors. American aid in the initial post-war years provided a crucial foundation. More importantly, the Japanese government implemented strategic industrial policies, fostering key sectors like steel, shipbuilding, and later electronics and automobiles. This focused approach, coupled with a highly skilled and diligent workforce, laid the groundwork for rapid growth. A culture of high domestic savings also played a pivotal role. Japanese households traditionally saved a significant portion of their income. These savings were channeled through the banking system into industrial investment, providing the capital needed for expansion and technological advancement. Export-oriented policies were central to this strategy. Japan focused on producing high-quality goods for the global market, leading to substantial trade surpluses year after year. These burgeoning trade surpluses were a key ingredient in Japan's rise as a lender. The stronger yen made Japanese exports more expensive but also made foreign assets cheaper for Japanese investors. This period set the stage for Japan's ascent to the pinnacle of international finance. By the late 1980s, Japan had firmly established itself as the world's preeminent lender. Its net external assets were the largest globally, a clear indicator of its financial dominance. Japanese banks such as Dai-ichi Kangyo, Sumitomo, and Mitsubishi topped the lists of the world's largest financial institutions. They were not just lending to developing countries, they were also major players in the financial markets of developed nations, including the United States and Europe. Japanese capital flowed into U.S. Treasury bonds, real estate in major global cities, and corporate acquisitions. This was the golden age of Japan's financial empire, a time when Tokyo seemed to be the undisputed financial capital of the world. The Ministry of Finance and the Bank of Japan played significant roles in managing these capital flows, though the private sector was the primary driver of overseas lending and investment. The global impact of Japan's lending was profound. It financed infrastructure projects in Asia, supported governments in Latin America, and invested heavily in Western economies. Japanese Official Development Assistance, ODA, also became a significant tool of its foreign policy, further cementing its influence. This financial clout allowed Japan to project soft power and secure access to resources and markets. However, the very factors that propelled Japan to this zenith also contained vulnerabilities. The late 1980s in Japan were characterized by an extraordinary asset price bubble. Stock prices and urban land values soared to dizzying heights, seemingly disconnected from underlying economic fundamentals. The Nikkei 225 stock index reached its all-time high in December 1989. This period of bubble economy was fueled by aggressive lending practices, low interest rates, and widespread speculation. There was a pervasive belief that prices would continue to rise indefinitely. companies and individuals borrowed heavily to invest in stocks and real estate, further inflating the bubble. The inevitable happened in the early 1990s. The bubble burst. The Bank of Japan, concerned about overheating and inflation, began to tighten monetary policy in 1989, raising interest rates. This pricked the bubble, leading to a sharp and prolonged decline in stock and land prices. The Nikkei index plummeted and real estate values collapsed. This had a devastating impact on the balance sheets of Japanese banks, which were saddled with massive non-performing loans. Corporations that had borrowed heavily against inflated assets found themselves in severe financial distress. The wealth that had seemed so real evaporated quickly. This marked the beginning of what came to be known as the lost decade. The economy stagnated, experiencing anemic growth rates and recurrent recessions. Beyond the immediate aftermath of the bubble's collapse, Japan faced deeper structural challenges that contributed to its declining lending capacity. One of the most significant is its rapidly aging population and shrinking workforce. Japan has one of the world's oldest populations and lowest birth rates. This demographic trend has profound economic consequences. A smaller workforce means lower potential economic growth. An aging population places increasing strain on public finances, particularly through rising healthcare and pension costs. This demographic reality has been a persistent headwind for the Japanese economy for several decades now. The aging population also impacts savings behavior. Traditionally, Japan had a very high household savings rate, which provided a deep pool of capital for investment. However, as people retire, they tend to save less and may even start to draw down their savings. The need to fund Social Security for a growing elderly cohort puts pressure on government budgets, diverting resources that might otherwise be available for overseas investment or domestic growth initiatives. This demographic shift is a slow-moving but powerful force reshaping Japan's economic landscape. Compounding these demographic pressures is Japan's enormous government debt. Decades of fiscal stimulus aimed at reviving the stagnant economy, combined with rising Social Security expenditures, have resulted in public debt levels that are the highest among developed nations. These internal pressures have collectively constrained Japan's economic dynamism. China's economic transformation has been extraordinary. Starting with market reforms in the late 1970s, China became the workshop of the world. This rapid growth lifted millions out of poverty and made China the world's second-largest economy. China's financial power grew with its massive foreign exchange reserves. The Belt and Road Initiative, launched in 2013, marked China's international lending. China funds and builds infrastructure projects across Asia, Africa, and beyond. State-owned banks like the China Development Bank became major financiers. China also created new multilateral development banks, reshaping development finance. This approach increased China's influence in developing countries. The story of Japan's displacement as the top lender is not solely about China's rise, it also reflects a broader diversification in global capital. While China is now a dominant force, other nations and new financial entities have stepped up their international lending. The global financial landscape today is more multipolar and complex than during Japan's peak. Countries seeking capital have more options, intensifying competition among lenders. Emerging economies beyond China have become significant players. Nations like South Korea, Singapore, and oil-rich Middle Eastern countries are active international investors. Sovereign wealth funds have grown in size and influence, deploying capital globally. These funds, often fueled by commodity revenues, represent a powerful new class of global investors. Losing the title of the world's largest lender has tangible and intangible consequences for Japan. While Japan remains wealthy with substantial net foreign assets, its decline in lending affects its international standing. The ability to shape global development agendas through financial weight is somewhat diminished. Economic power often translates into geopolitical influence, making this shift significant. It necessitates a recalibration of Japan's foreign policy and economic diplomacy. The slowdown in net foreign assets growth means slower overseas investment income. For a country with an aging population and high domestic debt, this income stream is crucial. Existing investments generate returns, but outward capital flow has lessened. Japanese corporations face stiffer competition in global markets. The global financial stage is more crowded, requiring greater effort to secure ventures. However, Japan remains a formidable economic power. It possesses a highly advanced industrial base, a skilled workforce, and a tradition of innovation. The shift in lending status is an evolution in its global economic role. The current reality requires an adjustment in national perception and a search for new avenues to project influence and ensure prosperity. Japan faces the challenge of charting a course for sustained economic vitality in this new global environment. Strengthening its economic fundamentals and enhancing global competitiveness remains crucial. Several strategies could help Japan navigate this future. A renewed focus on innovation is paramount. Investing in research and development, fostering a vibrant startup culture, and leading in next-generation technologies like AI and robotics. Structural reforms are essential to unlock Japan's domestic economic potential. Promoting female participation in the workforce and encouraging corporate governance reforms that spur investment and risk-taking. Strengthening economic partnerships and engaging in global trade will be vital. Japan's path forward involves adapting to a multipolar world with technological prowess and innovative solutions.